How does leverage work in the shadow banking system? Imagine a system where financial firms can borrow money quickly and easily, but outside the usual rules that govern banks. That's what the shadow banking system is all about. It includes finance companies, money market funds, structured investment vehicles, and broker-dealers. These entities borrow short-term funds to buy longer-term or riskier assets. This process makes their investments bigger than the actual capital they have on hand. The process starts when shadow banks issue short-term debt, like asset-backed commercial paper, or engage in repurchase agreements. These are like short-term loans backed by assets they already own. They use these assets as collateral, which can be repackaged and sold multiple times through special purpose vehicles. This layering allows shadow banks to stretch their funding for beyond their initial capital. It's a way to amplify their ability to lend and invest. Because shadow banks depend on wholesale funding markets rather than insured deposits, their leverage is very sensitive to market confidence. When asset prices go up and collateral values are high, they can borrow more cheaply and increase their leverage. But when markets turn sour, falling asset prices mean higher margin requirements and bigger haircuts on collateral. This forces shadow banks to sell assets quickly, which can cause prices to drop even more. This cycle can make financial instability worse during downturns. Unlike traditional banks, shadow banks do not have direct access to central bank support or government guarantees. This makes their leverage and funding risks less regulated and more unpredictable. The complex web of securitization and interconnections between banks and non-bank entities can hide how much risk they are really taking on. Historically, leverage in the shadow banking system helped expand credit before the financial crisis of 2007 to 2009. It especially fueled real estate markets by creating large amounts of credit outside traditional banking oversight. Shadow banks could repackage risky loans into securities that could be traded, allowing them to lend more. But when confidence fell, this same leverage amplified shocks, leading to a financial crisis. In practical terms, shadow banking leverage works through borrowing short-term funds using assets as collateral. They pool loans and slice them into securities, which can be further repackaged, increasing leverage. They fund long-term or illiquid assets with short-term liabilities, similar to regular banks but without the safety nets. Their leverage levels change with market conditions, rising during booms and shrinking during busts. This system allows shadow banks to do many of the same functions as traditional banks, like providing credit, but with different risks and less regulation. Their ability to amplify leverage has played a big role in shaping financial history, helping to expand credit but also contributing to financial crises when the cycle turns.